Welcome to Property TV. I'm Ian Thomason from Thomason Property, and this month we've got a really interesting interview with Professor Ross Guest, who's the Professor of Economics at Griffith University. We've also got our feature property of the month, but before we go to that, I'd like to take you to Kevin Turner for this month's property update. Thanks, Kevin.
Thank you. Well, young battlers are resorting to some pretty unconventional ways to break into the housing market. A growing number of parents are using their own homes as security so their children don't have to stump up a deposit. Others are buying with their friends and family, renting out a room or two, or buying an investment property just to make a start. Family equity loans allow applicants to borrow the entire value of a home and therefore avoid any costly mortgage insurance. Currently, only about 2% of first home buyers used a family equity loan according to Mortgage Choice, but that number is growing rather rapidly. And it also reflects the bank's relaxation of their strict lending criteria we saw only a few months ago. Some lenders will now allow applicants to use rental payments as proof of an ability to save. Look, it's all about getting your foot in the door, getting onto the property ladder. But once you're there, it's certainly going to require a lot of saving discipline just to stay there. That's all for this time. I'll see you next time.
Well, thanks for that, Kevin. Today we've come to the Gold Coast to the Griffith University campus to interview Professor Ross Guest. Ross is the Professor of Economics at this campus, and he's going to talk to us today about the economy but more importantly about the property market. So let's now go to that interview. Well, Ross, I'm asked just about every day by people, what do I think is going to happen in the market? Should they sell their place today? Should they hang on? Should they buy? I guess with all of this, I find plenty of reasons to say I think the market's going to stay flat, and I can't really find many reasons to say anything different. I'd be interested in your comment on where you think the property market is in today's terms.
I'd agree with you, Ian. Up until last year, the house prices in Brisbane had risen by about 10% per year on average. Now share prices have only gone up by 4% per year on average over that period. Now that divergence in growth rates can't continue between those two asset classes. So last year prices came off in Brisbane by about 3.6%, 1.9% nationally, and I think we'll see a flat or slightly falling market for the next few years.
And what when you say for the next few years, what are the signals that you think that we can look for that would give us an indication that things are getting better?
Well,
or going to get better?
I think that households are saving more now. They're rebuilding their balance sheets in the wake of the global financial crisis. There's very low confidence out there. So households are reluctant to take on more debt. So there needs to be that rebuilding. That rebuilding's got a little way to run yet. This deleveraging in asset markets has got some way to run yet. So I think we're going to see another few years for that to play out. And as I said before, I think we need to see share prices catch up to house prices before house prices can take off again.
So is this basically economically driven or sort of consumer confidence driven? What do you see?
A bit of both. Confidence is important. I think we need to see the global picture stabilise a bit. I think we need to see the American economy improve. We need to see unemployment come down. Their unemployment rate's got a 9 in front of it at the moment, and I think that needs to improve. I don't think we'll see the sort of house price collapse here that we've seen in the US for a couple of reasons.
Well, when you say a couple of reasons, what are those reasons?
Well, firstly, their economy is a lot weaker than ours. I mean, unemployment rate of 9 point something up towards 10%. Our unemployment rate's got a 4 in front of it. Their interest rates are basically zero. Their official interest rates are zero. So their central bank hasn't got much room to move. Yeah. Whereas here, if our economy were to significantly weaken, the Reserve Bank's got a few percentage points of interest rates to play with. Yeah. It could cut. Secondly, their mortgage markets are different to ours, as you know, and they have non-recourse loans. We have full recourse housing loans. So what that's encouraged in the US is encouraged people to take on too much debt, knowing that they can walk away from their loan. If their house is worth less than their mortgage, they can simply walk away. So that's encouraged borrowers to take on too much debt in the US.
Yeah. Ross, there's been a traditional 7-year cycle, or the property tied in with the property clock, and that 7-year, 9-year cycle has been pretty traditional over the 40 odd years that I've been in real estate. I've got a sense that might be getting blown out of the water this time round. And what are your comments on that?
Well, I don't think we've seen the end of cycles. Now, whether it's a 7-year cycle or a 5-year or a 10-year, I don't think anyone can say, but we haven't seen the end of cycles. There's a lot of momentum in house price growth. House prices tend to be a lot more stable than share prices. Shares are very liquid, whereas houses are big lumpy things, they're illiquid. There's a lot of momentum. Once prices start to move in a direction, people tend to extrapolate from short-term price movements. They think that they're going to last some time. And so what that does is it builds in momentum into share price. So it takes a while for that momentum to turn around. So we're not going to see the end of cycles.
Well, Ross, thanks very much. It's been good coming down here to talk to you, and I appreciate your time. And might be that we catch up again in the next year or two and revisit the subject.
See how those forecasts went.
Okay. All right.
Okay.
Thanks, Ross.
That's a pleasure.
Okay.
Nestled in a quiet leafy street surrounded by picturesque homes, exuding immense traditional charm and appeal, sits this 3-bedroom cottage. The spacious sunroom is perfect to curl up and read a book. The sun-bathed, north-facing rear garden and outdoor entertaining area is ideal for family gatherings. With a fantastic scope to restore this cottage, and the Racecourse Road, boutiques and restaurants are only a short drive away.
Well, I'm sure you'll agree that Property of the Month is a great property. And of course, if you'd like to buy that or like any more information, don't hesitate to contact us on 3262 1466 or go to our website, thomasonproperty.com.au. So until next month, this is Ian Thomason saying, I hope you have a great month.